Stellenbosch-based investment group PSG was founded by Jannie Mouton and has a market cap of 13 billion rand. PSG's main investments are 35% of Capitec, wholly owned PSG Financial Services, 63% of private schools company Curro, and 42% of agricultural investor Zeda. PSG has a price-to-earnings ratio of 14 and a dividend yield of 1.4%. So PSG's got a lot of very good assets under them.
And has done spectacularly well. I mean, Jannie owns about 23% of PSG, so that makes him, worth about a quarter of 13 billion rand. So he's done well out of it as well. But they've had amazing foresight, and this structure doesn't, in fact, have a fee, earnings, performance-based type of thing inside it. Zeda does, and we'll talk about that earlier. But for the moment, anyway, PSG really just consists of their investment stakes, and that's how it gets valued year to year. Sometimes they are investing, sometimes they're extracting value. But really, its big success in recent years has been on the back of Capitec, which has been a wonderful success, as we all know.
Indeed, a wonderful success, that Capitec. But there's also that whole scary thought of unsecured lending. What do you make of it right now, Mark?
Well, yesterday Abel had a conference call, and this morning we saw First Rand CEO come out with a statement that yes, there has been an uptick in unsecured lending. They're not, from their point of view, they don't see it as a bubble. We're concerned that with all the strike action going on, that a lot of the strikers obviously have microloans out and whatnot, and it is unsecured. I think in the case of PSG, Capitec is not so much an unsecured lender as more of a bank. It's an actual bank. But obviously over the last few years, and it has really done unbelievably well in targeting the low end of the market. And in response, the big four banks have moved quite aggressively into that space. Capitec's not cheap. I mean, it's the most expensive bank we have in South Africa. It's like trading on almost 3.5 times price to book. Its ROE is pretty good. Its ROE is solid at around just over 20%. I'm not sure they're going to continue to. And PSG's ROE itself is 18%, which is a really good return on investment considering the breadth of its investments. It is very skewed towards financial services with PSG Consult, the stockbroking, the asset management, the life insurance. So I think if there is a bubble in unsecured lending, I don't think it's going to be a train smash for PSG as a whole, although it might in the short term add a bit of risk to Capitec. And something that was worrying us was the sale by their CEO of quite a big chunk of his stake in Capitec. It's never a good sign to us when management decide that this business is fully valued. We don't see the Ruperts, exiting British American Tobacco. That's why I get a bit worried when I see, Riaan Stassen exiting Capitec to a large extent.
Cool.
Yeah, look, I'm not too worried about Riaan Stassen having sold a few shares because let me tell you, when a company goes from 2 Rand to 200 Rand, a lot of people make a lot of money very fast. And as a result, if their entire net worth is tied up in those shares and they take, sort of 10 or 20 or 50 million off the table, they still got lots of shares. So it's not of enormous concern. I don't know though, I am ambivalent. I agree with Mark that Capitec is ludicrously expensive relative to its peers. We're long African Bank and have always been. We've got a few clients that own Capitec, not enough. So it's always been a bit of an anomaly for me. So I'm not worried about micro lending. I quite like the educational assets. I think Curro's got a bright future, although also I think it's pretty expensive. But look, the share price of PSG has gone off the boil a little bit. It hit an all-time high of 70 Rand a share. It settled back to around 63 or something. The problem really, though, is that when a company like this does well for 3 or 4 or 5 years, people get used to the idea that it always goes up. But it should be remembered that a company like PSG is really only the aggregation of its underlying interests. But they have achieved a great visibility. They get a lot of deal flow because people come to them. Jannie, Chris and Jaap and all those oaks are all still involved in the business. So I don't think buy it here because for me it's a little bit pricey. So I'm not hot on it per se, but I don't expect it to blow up or do badly.
Would you be buying into Zeda, Mark?
PSG, yeah, PSG, no, not at the moment. You also think, if I take a look at its valuation, I mean, it's trading on a sort of a 14 historical PE. I mean, it's definitely not cheap. Going forward, we're not quite certain what's going to happen with Capitec in terms of provisioning, etc. And we'll talk next about Zeda. We've seen Pioneer's margins get squeezed with the higher grain price. So, I think there's much better value to be had out there. If I wanted to invest into food manufacturing, I'd buy the likes of Tiger Brands. If I wanted to invest in a bank, I'd rather just buy First Rand, which is a lot more liquid. So for us, no.